everybody. Welcome to the TraderMerlin show. It is the January, we're on the January 3rd edition, our first one for 2023. Hope you all had a nice little holiday break, took the last part of December off, and did something fun for New Year's. Down here in Southern California, it was ugly and rainy, so a lot of people I know didn't do a damn thing. Today's show is going to be pretty much all about forecasting, thoughts about what's going to happen in 2023. Maybe I have kind of 5 really kind of key areas I think are going to be critical for this upcoming year. So I thought I would do that, but it's going to be very interactive here today. I only have like 30 of you guys in the room right now, so I'll wait a little bit longer before I get into the polling of you. As you guys might remember, last year on our January edition, our first show we did for 2022, I asked you guys what your thoughts were on the S&P 500. So I'll get to that here in a little bit. Tomasino and I made a wager over the weekend. I guess I could have worn my 49ers jersey. I'll wear it tomorrow, no problem. She bet me that the Raiders would beat the Niners, and I said the Niners will beat the Raiders, and that actually turned out to be way closer of a game than I thought it was going to be. But Tomasino, where's the proof? I need to see pictures of you wearing your 49ers jersey around. I'll put my Niners one on for tomorrow just for good measure. And, you know, thoughts go out to the Buffalo Bills player last night. I don't know if anybody saw that one. Cardiac arrest on the field. Scary, scary sport, but I guess, you know, when you get paid millions of dollars a year, you get paid to take that risk. So I hope all turns out well for him. All right, let's go into today's show. So what I want to do first off is do a little bit of a January challenge. There are commercials, Option Merchant. I'm still doing the what do they call it? There's commercials that YouTube puts in because it gives me a little bit of revenue and pays for my hosting costs, my streaming costs, and some of the other and my website stuff. So a little bit of unfortunately, I got to do the advertisements. So anyway, you got a free show. A little ads won't hurt anybody. Let's go ahead and start things off with what you can do for yourselves. Forget about the markets are going to do this year. Obviously, we have our thoughts on what's going to happen there. And we will see my thoughts here in a second, plus all of your forecasts for what you think is going to happen in 2023. But I guess the most important thing is that we take care of ourselves and we do something to improve our personal, I guess, position in life, the things we do. And I do this every now and again just for fun, just because I like to do a challenge, just because it keeps me going, gives me a goal to achieve. And really the way it works is for 30 days, you just tell yourself, I'm going to do this thing every single day. I will do this. And what is it? For many of you, it might be, I'm going to go walk 5 miles, or I'm going to read a book. I'll do one book a month, or whatever the case may be. Find something out that you're going to do for yourself. So here's what mine is going to be. I will leave this up here, and if you guys want, feel free to type into chat what you are going to do for the month of January. This is going to be every single day. I actually hurt my back, so I might have a little bit of issue with my 50 burpees a day, but I'm going to do 50 burpees a day, as well as write on my book for 30 minutes. Of course, I have 2 of them right now, so it's going to be a little bit... I don't know which one I'll be working on, but I have a feeling it'll be the more story. Yes, I haven't done them yet, Lisa. My back's been hurting me, but I'm feeling better today, so I'll start with my 50 today. But I'm going to do 50 burpees a day, and if you want to be a part of this one, just type in a chat what you will be doing for the month of January. I'll add you to the list, and then I will gently remind us as the month progresses here what you guys should be doing on a regular basis. So if you want to join me, type it in the chat, or you can email me at TraderMerlin@gmail.com, and I will incorporate it into the list. Don't make it too lengthy. Something real quick, simple, easy. Okay, now the next piece is a common question I get every year. And as you guys know, I do have a magical name, which is awesome, but I'm no oracle. I have no better forecasting ability than anybody else out there. It's just I think my plan is a bit more solid than most with regards to following my rules. So I get this question every year, so I figured out, well, let's just do it. What's a burpee? I will find a video for you and show you what a burpee is. It basically, you stand fully, like you're like a normal, just stand normal, and then you drop down into a plank position. So go down to a plank. I add a push-up at the end, and then you jump back to your feet, and then jump as high as you can, and then do the whole thing over again. It is pretty... They're tough. They sound really easy, but especially if you add the push-up at the end, it is the one exercise that probably gives you the best all-around body workout, from your legs to your shoulders to your arms to your back to your chest. It's the full workout. So, all right. So I get this question: where are the markets headed in 2023? Look, hell if I know. You know, I'll sit here on today's show as well as with you guys, give a little bit of back and forth, see what you guys think, because some of you may be more correct at the end of the year, and that's awesome. I really don't have any hurt ego if my forecast doesn't come true. I was happy. My outlook was pretty spot on for 2022. I was a little, 100 points off or 200 points off in the S&P, but no big deal. So where are we headed? Well, I have a couple different headwinds, as I mentioned. I'm going to be writing 4 of them here, particularly, then going into the details of each one. But what I'd like to start off with first is I'd rather get your guys' forecast. So I have a lot of reading to do because I need to go back through here and add all of your challenges here. Awesome, good. And you know, for all of you doing the challenge, if you're doing something like a burpee challenge or a push-up challenge or even just jumping jacks, I mean, heck, if you did 100 jumping jacks a day or 100 squats a day, you will see the difference. And I don't want to see these pictures, but I would highly recommend for you as a motivational piece, if you want, you should stand in front of a mirror and take a picture of it, you know, in your bathing suit or underwear, whatever you want, and take a picture of yourself, and then you'll notice the difference in 30 days. I did a 100 push-up challenge a few years back. I did it multiple times. But I took a picture day 1. I took a picture at the end of 30 days, and I was actually pretty shocked at the tone and definition of my latissimus dorsi, my shoulders here. It was pretty awesome. Yeah, I don't think you can post links. I don't think the attendees here can post links, but let me see here real quick. I'll see if I can post a link to you guys or I'll show you a video because I have a special type of burpee that I do. They're very, very challenging. And, you know, start small. Hell, if it's even do 5 burpees a day, it's something that keeps you focused. Okay, let's go into forecasting. So if we look at the S&P 500, let's go run through here. Here's our S&P, which didn't start off with a good day today. We still are in play for the Santa Claus rally, by the way. No, don't share the picture with me, Lisa. Those are just for your own personal development. I don't want to see the pictures. I mean, unless you're really dying for feedback, sure. But you know, I think everybody should you know, do them for own personal benefit there. So, by the way, you guys do know that the Santa Claus rally is still in play, right? It feels like there's been nothing but negative. You do know that the S&P, since I've mentioned here on this program, that the Santa Claus rally is the last 5 trading days of the year plus the first 2 of January. Now, just since I've got a captive audience here, where do you think we are so far? Do you think we're positive or do you think we're negative on the market rate of return since the last 5 trading days of December and the first 1? We have 1 more day to go. But remember, the average annual rate of return, I believe, is about 1.3% for those last 5 days into the first 2 of January. What do you guys think? Think we're going to make it? It might surprise you because it feels like we've had just so much negative news, especially days like today, which are, you know, pretty ugly for a while. I think a lot of people are going to say Santa Claus rally didn't show up. Well, let's go out here to the SPY, and I will show you exactly where we stand. Here's the snap icon. We'll go to the last 5 days, which was started actually on Friday, December 23rd. We'll go from the open there, right, which is the bottom of that green candle, and to where we closed at right now. We're actually up 0.31%. So up a little bit, just ever so slightly. And you know, if we get a 1% day tomorrow, then Santa Claus rally actually came true. And we'll see what it pans out for me. I don't know why I did this, but as you guys know, as the experiment, I actually bought the QQQs, which is somewhat stupid, I would say, because the study's on the S&P. I don't know why I decided to go with the Qs. But the Qs are actually down 0.37%, so I will probably lose money on that trade unless we get a nice big rally tomorrow. We'll close that one out by the end of day tomorrow and report back to you what my QQQ trade did from a net rate of return percentage. Right now, the Q is down 0.37%. All right, so if we take a step back and just let's go to the S&P and look at the longer term picture here, where we've come from, where we're headed, and then try to hypothesize about where we're going. So if we look at this picture here, and this goes back into the pandemic lows of 2020, you can even see back in 2019. I could go back further if we wanted to, just to get a better picture of the long-term uptrend here, and really this prolonged pullback we've had since late, call it November, December of 2021. So we've been on this downtrend for a little over a year now. The good news is it does feel like it's starting to consolidate here, but it's still making lower highs, which is the most important part in a downtrend, although it appears to have made a higher low recently. So I will tell you what my thoughts are as far as what I think the S&P is going to do by the final day of the year, and I'll give you my number. I'm curious, though, what you guys think. Right now, the S&P 500, the futures, let's just do the cash index. That's probably the better way to go. Right now, the cash index is 3,824. So 3,824 is where we are right now on the cash index for the S&P 500. Go ahead and type into chat what your forecast is for the end of the year. I went all the way through December, whatever the final trading day is, called December 31st, where you think the S&P will be. Most likely somebody will be the closest. We've got 73 people in here, so everybody type in a number that you think. And of course, we'll all, the last day of the year, I'll go over that one to see who got the closest. And if I can find some prize or something to send you, I will. Since I think, Mike, you won it this year, I think I'll try to do lunch with you or something if we can. If not, I'll send you some TraderMerlin shot glasses. So type in a chat where you think the S&P is going to end up for the year. And I'll give it just a little bit of leeway in here. I'll be a little time for you guys to type in your numbers there. Just, it doesn't really matter if you're right or wrong. It's just you have ideas in your head as to why, right? And if this was more of a forum where I could interact with you and have quicker responses, I would probably just open this up and say, okay, who wants the microphone? You tell me why, Mike X Coder, why do you think it's going to 4,500? What are the variables driving that? And ultimately, for everyone here, some are saying it's going to be higher, some are saying it's going to be lower. Randall thinks we're going to have a significant meltdown. Bottom line is, who cares, right? Not to sound condescending, but who cares? If you think it's going to be 2,500, then wrap a plan around that and say, okay, how am I going to trade it as it gets there? I see Alan saying 440, 44, 44. All right, if you think that's it, then how are you going to wrap a trade plan around that? What are your steps to capitalize on those moves? And what do you do if you're wrong, right? That's ultimately what trading is all about. We talked about trade plans with Ryan Watkins, and everybody right now is just, you're all throwing darts and saying, this is what I think it's going to be, and we have our reasons. I have mine as well. So awesome. This will take me at the end of the show today. I'm going to have to spend a lot of time going through the show for our January competition or challenge, as well as all the numbers you guys have put in. Way more than we've got last year. So cool. Awesome. Now let's go into what I think is going to happen. I'm going to run through some variables here, and it is really based off of this right here, the 2023 market outlook. And, I guess I'm supposed to do a disclosure. Oh, Anna, you think we're getting to 1574? Hold on a second. Before I get to that 2023 outlook, I just got to go bring up a quote on 1524. So I'm going to have to go to a weekly to find levels that low. 1574, excuse me. Look, not that it can't get there, right? It could absolutely. It's just the odds are pretty slim. 1574, you're looking right down there. Okay, so if we were to get to that 1574 level, you're looking at a decline in the S&P of another 58% this year. I gotta say, I would love it. If it got that low. I mean, I don't think we're going to be that down for the year, but hey, a 58% drop means a lot of opportunity, a ton of opportunity. Personally, I don't think we'll get there, but again, my opinion doesn't matter. It's your trade plan and on how you decide to operate off it. Options merchant saying 24. You're looking at some of these lows right here. Obviously, the pandemic low, which I think is what you're targeting there, options merchant, is your most logical one. Hey, Bill Lattis with this. What's the S&P? Isn't that a bond program? Good to see you, Bill. The Standard & Poor's 500 is what we're looking at. Just kind of doing a little bit of a market forecast and outlook for 2023. Okay, so, yeah, Chris says they are calling for 10 to 15% declines. Who's they? Is it Jim Cramer? Well, which basically means we'll probably be up 10 or 15%. Here's the things I see. And, of course, I am not financial advice. I'm just showing you what I see, and I will make a trade plan accordingly. I would encourage all you to do so as well. And if you are in a trade or a situation where it's not doing what you thought it was going to do, get out, right? Move on to something else. So Nick says Bitcoin will go lower. We'll talk about Bitcoin. Let's talk about broad markets first, and then we'll go back through and look at some other markets as well. So for 2023, I think I kind of got to break it down to what's important. And I've mentioned this before. Over the course of financial markets, there are certain things that become much more prevalent right now versus what's going to be in 6 months. And it always seems to rotate because, right now, there's a couple really important pieces, which I think we would all agree are the major ones to watch out for 2023. But there might be some pieces that start to gain importance maybe near the tail end of the year as the relevance of data starts to, jockey for position of importance. So that was a long-winded explanation that may not have said anything. That was like Greenspan speak right there. So the first thing, in my opinion, that is going to be the big driver, it's real simple. It's interest rates, right? We have been on interest rate watch on this program for quite some time. You guys know I'm always bringing up, let's go here and we'll go current. I'm always bringing up this on a regular basis with you guys just because this kind of shows you what the market is expecting. And right now, we have a meeting for the FOMC on February 1st. It'll be a Wednesday, and they are expecting a 72% chance of a 25 basis point increase. So remember, we had 75, 75, 75, 50, and now all of a sudden, hey, maybe we start to drop to 25 basis points, which means the Fed is definitely toning down its aggression because inflation may be getting under control. We'll talk about that here in just a second. There's also a 27.8% chance that we are going to get a 50 basis point increase. But let's just look at what the Fed is saying for the year. Right now, we're at 4.5%. Now, with a 4.5% Fed funds rate, that equates to roughly a 6.5%, maybe 7% 30-year fixed rate mortgage, right? That's kind of how my brain's thinking. And again, if we start to get really high 30-year fixed rate mortgages, you're going to start crashing the housing market. We're already seeing that happen. Now, let's see what the year holds. And again, this is not my opinion. This is what traders are putting on the line with their S&P futures Fed funds futures forecasting for the end of the year. So as you can see right here at the top, we have a meeting February 1st, March 22nd, May 3rd, June 14th, July 26th, September 20th, November 1st, and December 13th. As our native expert here, Mr. William Addison chat will tell you, there are 8 FOMC meetings per year. So for the end of the year, they're expecting rates to be unchanged. Right now, it's saying that there is they're expecting rates to be 25 basis points higher by December. Now, if we look back at what happened in 2022, we saw rates pretty much go up 4.5%. A ridiculous increase in Fed funds policy. Now, if last year we had a decline in the S&P 500 of roughly, let's call it 20%. I know I'm rounding up. It was 18 something, but let's call it 20. If the S&P fell 20% as the Fed funds rate was raised 4.5%, what do you think is going to happen if the Fed funds rate is only raised 25 basis points, 0.25% for the year? My gut tells me that that's a sign of economic promise, that things are probably going to start to look pretty good. Now, of course, that's looking way down the line. So I thought that was a relatively interesting one. The other piece here, and for those of you who may not have this link, I actually love this link. I go here on a regular basis. I will post it in chat for you guys. I would encourage you to check it out. This is the link to the FOMC. Bookmark this one. It's not the FOMC. It's the CME group. If you scroll down here, it gives you what's called a dot plot. And I love the dot plot chart because you can see here 2022, we've pretty much finished. Well, we have finished. And it shows you the forecast for 2023, which is interesting because right now the Fed funds forecast is showing 5.25 by the end of next year. That's where the consensus is for the FOMC. So our Board of Governors of the Federal Reserve, in their opinion, have said that we are going to get to 5.25. That's the average forecast. Yet, the futures, the traders are only pricing in 25 basis points. So I thought that was interesting because the market, the FOMC has said average 75 basis point increase by December, but the market is pricing in 25. So we already have a big separation between market expectation and actually what the Fed is expecting. So I find that rather interesting, but notice the trend here. You see that 23, 24, and 25 all looking like, declining rates. Of course, who the hell knows, right? That's so far away. It doesn't really make a difference to even ponder what's going to be like in 2025. Really, it's important to say what's happening here, expectations for 2023. So I thought this was interesting because the Fed dot plot is so different than the current expectations from the traders themselves, the actual traders. So that, to me, will be one of the major pieces here is going to be interest rates, right? And the way that interest rate policy going forward has a huge impact on the cost of capital, has a huge impact on real estate, et cetera. And we could tie together all of those little dominoes. And to me, that makes interest rates number one. Now, the question will become, what does Bill Addis think? I don't know if he's still here, but he's welcome to type in chat there, Bill, if you want. Obviously, we have to look at what's going to influence those interest rates. Right now, those interest rates have risen predominantly for one reason and one reason only, and that is inflation. So I guess the second bubble on my list here has to be inflation. And I'll be honest, I'm getting kind of sick of talking about inflation, right? I saw a comment here. Ellen says, eggs went from $7.50 for 2000 last week. Wow, really? I did not see that kind of shift in price. I have to go get some new eggs here because I'm just about out. But $7.50 for 2 dozen. Yeah, I'm looking about $4 or $5 for a dozen out here in California. So it's pretty damn steep. But I don't see prices falling that quickly. Hopefully they will continue to fall faster. So inflation is the other major issue. If we start to see things slow down, then the Fed can backpedal. And looking at the interest charts I just showed you, the Fed dot plot, as well as the FOMC futures traders, their expectations seem to be dialing it back a little bit. So it looks like 2023 will be much more calmed down than it was in 2022. So when we look at inflation, we really have 4 different pieces that we need to look at. Well, 3 different pieces we have to look at. Number 1 will be producer price index. And here you can see PPI. This is what it costs producers to make a specific basket of goods and services. Now, the reason I like this is if you look historically, I think we would all agree that a PPI number that's at 0.5 actually seems to be a bit high. And 0.5 is going to be right. I get my drawing. It seems to me like where I'm drawing this red line, historically, is like the most average point. I'm sorry, it's got a wave to it, but I think you guys all agree that where I drew that red line, if we go back into 2013, 14, 15, all, etc., that red line seems to be average, if not maybe even a little bit high. And we are right now at 0.3%. Which is in line with historical averages, right? So 0.3% times that by 12 gives you what, 4%? So that'd be 4% inflation according to PPI. It's this surge we had here in 2021 and early 22 that really had that thing spiked. So it is interesting to see the quick decline. Now, we've only had this for a few months. It really depends on, is this here to stay? Do we see this trend of declining PPI keep going? If so, then the Fed will probably pivot rather quickly. So that's your PPI, which is what it costs producers, but you and I don't care so much about that because we're consumers. And this is an even better picture, right? Look where we are right now. We're at 0.2. You can see right over here on the hard red edge, we are at 0.2. And if you go just to directly to the left, you notice that seems to be the average going all the way back into 2010. So it feels like this is, I hate to say it, I'm not a conspiracy theorist or sounding like a politician, but it seems like we're getting to the point where this crazy extended inflation data we were seeing is starting to subside significantly. Are we out of the woods yet? I don't believe we are, but do we start to see the calming? I think that's very, very positive for our markets going forward. So right now, the previous number was 0.2%, so I feel like we're back to some semblance of normality. Are we out of the woods? I don't know. But remember, the Fed has said it's not PPI or CPI, it's core PCE price index. And I think this is an even stronger example of, if you look at that 0.2%, right? There you go. And you go all the way back here. It's historical average, seems to be about 0.2%. So this does feel good from a macroeconomic perspective. And again, I'm not trying to force an opinion here. I'm simply looking at the data as it's presenting and saying, okay, well, what is this data showing me and how might I be able to react to it? Okay. Let me see real quick. I got a whole bunch of comments coming through here. Once oil starts higher, then forget about control. Yep. And true. And, you had days like today. So if we go back here to our charts, look what happened with crude oil today. You're down 4% on crude oil. Get this back to some normal chart here. We go to a daily. This has absolutely been helping, right? There's no argument that this decline in oil from its peak back here in March of 2022, when we're up at about 130, that the decline ever since then has absolutely been helping the inflation numbers. The big question is, does it continue? And I don't know. That's that $50 million question, or billion, whatever price tag you want to put on it. You look at the longer term picture here, taking out that low we saw back in 2020, which we'll never see again. I don't think so. Does this picture illustrate that we are now in a predominant downtrend and we should focus on declining oil prices, or is this a pullback and a bigger uptrend into an area of demand? I don't know that yet. I'm in the camp of, it feels like we're in a period of further declining prices in oil, just because the chart shows that since 2022. However, given Russia and all the interest in moving away from fossil fuels and electric vehicles, I don't know, it feels like there may be more downside pressure, but I don't want to hang my hat on that one going forward. First time ever at work, I'm trying to chat. There is a Santa Claus rally skills stocks, man. It's not fully there yet. S&P's up 0.3% since the Santa Claus rally started. Historical average is 1.3. So if we get 1% tomorrow, then we will have our Santa Claus rally. We'll officially have a ribbon. And by the way, just so you guys know, if we don't get a Santa Claus rally, historically, January is a negative month. If we do get a Santa Claus rally, historically, January is a positive month. So if you're bullish, you're hoping for a 1% or more gain tomorrow in the S&P. If you're bearish on the markets, then hey, just sell off and let's have a negative January. But just kind of interesting to see the historical statistics there. John says, other than Microsoft and Apple, which companies are holding up the S&P and QQQ? Would it seem like they surged down? You know what? It's funny because you say what's holding it up. Anything but tech. It feels like everything but tech. Yeah, I should have a moderator, huh? I should, absolutely. Well, and the people who are regulars here know that if you want me to answer a question specifically, you put question marks before it. Because a lot of times I love when you guys chat amongst yourselves, but if it's something you want me to answer on air, just put a couple question marks before so I can scroll through like John did here. It's perfect. I think if you look at what's holding up these markets, it's anything other than tech. Certainly, I think energy companies were doing rather well at holding it up, and I think you could argue that financials may have been helping as well, utilities, and consumer staples. And if you look at the indexes, especially the composition of the Dow Jones Industrial Average, you don't have a ton of tech companies, right? You have a lot of consumer staples. Johnson & Johnson's in there. You know, you get some big names that are balancing it out, and when markets crash, people aren't going to cut out their toothpaste or their toilet paper, so those tend to do rather well. Is tomorrow the end of the Santa Claus rally? Yes. So tomorrow will be the official second trading day of the new year. So literally 5 minutes before the close tomorrow, I will close out my trade, hopefully for a profit, and I'll report back to you, but have a feeling I'll take a loss in the QQQ trade. Should have gone the S&P because that's what Santa Claus rally is tracking. All right, let me see here. So let's go to the next piece. Now, personally, I think there's a lot more than this, but I really just wrote down 4 things, and one of them actually has a whole bunch of pieces to it. So we did interest rates, we did inflation, and next piece is the bond markets, right? And this is the real tricky one, and there's a couple wrinkles that are going to, I think, maybe face our markets, maybe not 2023, but certainly coming up here with regards to cryptocurrencies, stablecoins, and digital assets on how that may impact the bond markets. When I say bond markets, it's, for me, the yield curve. And we've looked at this a lot in this program, which is something that many of you have literally never seen. Uh-oh. Did something freeze here? You guys I'm still streaming. Huh, that's interesting. My chart completely froze. So I guess I don't get a chart right now. 1 second as I close this bad boy out. Oh, I can't close it. All right, hold on. Let me open up a new browser over here. 1 second as I bring up all kinds of weird glitches going on my computer. Not sure why that is. But we'll bring up trade. Come on. Okay, so here is TradingView, and I will hopefully get to show you that chart. So, one of the big things for me has been obviously the bond market, obviously looking at the 10-year, and then I used to always look at the 10 versus the 2, which is kind of what the industry tells you to do. But in speaking with Bill Addis, and glad I have somebody like that in my corner to help me understand the bond markets, he says it's really the 10 and the 1. And here's your 10-year. TJ, no, that was my computer, JP. I don't know what that. And this computer I built specifically for the show, so it should not have had any issues. But something froze up there. Here's our 10-year, and I drew some lines really from this low we saw back in August of 2020. I took out the super big drop here just because, I don't know, I feel like that was an anomaly. But if you look at this trend, we could modify where this red line is drawn. We could modify maybe where this blue line is drawn, right? So you got 1 point there. Maybe we move it up here. And let me see here real quick as I try to get more points of contact. Might be able to contend that it looks like that. Either way, I'm not using the lines here as a determinant of necessarily the trend, but more the magnitude of the move. So as you can see, it feels like since 2021, obviously the rate of increases we did in 2022 have helped cause this curve to steepen here. And that acceleration hasn't really slowed down. I still feel like we're in a pretty big uptrend. So probability is going to tell me that I think that we're going to see these rates continue to go higher on the 10-year. If that happens, I think we all agree. If you don't, let me know why you don't agree. But if the 10-year keeps going up, then you're going to see more pain in the real estate market, which could be, one more piece to bring this house of cards down. But if we're looking at the bond markets, you got to ask yourself, what reasons could we look at to say that bond yields are going to drop? Right? One of the main ways that you would get bond yields to drop is if you had huge amounts of buying of bonds. So let's say China and Japan and the European Union, they're like, oh, yeah, we got problems. We want to buy U.S. bonds. So they go out there and they're buying everything that they can on our 10-year. If that happens and they all start buying those bonds, well, because demand is so high, then they can offer less yield. So instead of offering, 3.75% today, maybe on the next release, the next auction, all of a sudden it's 3% or 2.5% because demand's so high. The problem is we don't have demand. Not only do we not have demand, we have declining demand globally for our bonds, and we have a new seller in the marketplace, which used to be our biggest buyer. So if you wonder why these yields were so low back here, right, wondering why this was just historically low, one of the main reasons was the Fed was buying billions of dollars per month of the bonds that were issued by the Treasury. And the reason for that was they wanted to keep yields really low and help stimulate the economy. But now all of a sudden, the largest buyer of bonds, no, it's not China, no, it's not Japan, it's the Federal Reserve, is unloading their balance sheet. Right? They're selling those bonds in the open market, and now, or not open market, but they're selling those bonds. And what that's going to do is it causes so much more supply. And if demand stays the same, but supply increases dramatically in the bond market, that means higher yields because they're going to have to pay more money to entice people to buy this flood of 10-year. And that's what we're seeing. I think that's going to continue. So this is probably the most negative piece I see for our markets going forward. Yeah, we are coming into monthly supply, but remember, if you look at that, let's go to monthly here chart, and you could look all the way back here, this historical downturn that goes back to the 80s. We broke it. I don't care where you draw your trend lines. If you started that peak in the 1981 peak, when we were up around 16%, we broke the trend. Now the question is, where are we going? Scott McCormick back on November 1st of 2022, he targeted here 7%. I'm telling you, if we get to 7%, we could see some pretty big headwind for our market. Because 7%, if right now you're looking at 3.75, I'll round it up, call it 4% for a 10-year, and you're getting 30-year fixed-rate mortgages at about 2.5% higher than that, that means that if we do get to 7%, then you're looking at 9 to 10% 30-year fixed-rate mortgages. That's going to really start to hurt the market. So I thought I'll try to get him back on for the Beck Report, absolutely. Scott McCormick, one of my faves. But yeah, that's my take on our bond market here. The other part that is one of those ones I just have to shrug my shoulders because I really just don't even know. I've never seen anything like this. This is the yield curve between the 10 and the 1. And it's at historic lows. I mean, we are at levels, it's never been this inverted, at least on any chart that I've seen, right? You've gotten close back here in 2000s. Let's see how far back we can go on this one. Here's a monthly. Yeah, we were getting back down there in 2019 when we had our inverted yield curve, recession talk. Well, not only are we below those lows, but we're still drifting even lower. And here's the 10 versus the 2. Now, this is the 10 versus the 2. Now, we are past the historic lows from the 1980s and those levels back in 2000 when we had that inverted yield curve, and we typically went into recession in those markets. Karen says bond market is broken, and I would agree. I think that what the Fed has done, and again, people like to point their fingers at whatever politician, Trump this or Biden that or Obama this or Clinton this or Bush that, who cares? You mess with the bond market so much, bond market's way more powerful than the equity market. So when you manipulate something and augment what its utility was, right? The bond market has a definitive purpose, obviously. But when you manipulate that so much, I think you just create havoc in the system. And that's what I believe we're seeing now. What's kind of concerning for me is, you look back here, and these are monthly charts, by the way. Normally when it goes down really aggressive, it has a huge rip back up. And it's usually fairly quick. Well, we're still dropping. Like, we haven't even had our rip up yet. And at some point it will come, and maybe, maybe it's this year. I don't know. I think that we'll probably see this leveling out as the short end of the yield curve gets raised enough and the long end starts to drop. This difference between the 10 and the 2 will decline. Right now, you can get over 0.5% more for buying a 10-year versus a 2-year, and you can get almost a full percentage more for getting a 1 year versus the 10-year. That is just crazy broken market. And even the 30 and the 2-year is inverted, just overly dramatic. Now, it's right at those same levels we saw back in 2000 and back into 1989. So to me, bond markets are a major one. As we progress through the year, I will do my best to bring Bill Addison on the program more to talk about that and see what the shifts are. Maybe some policy changes, maybe different things down the pipeline that I don't see. But bond market, I mean, in order of importance, I'm questioning even having it third. I almost feel like the bond market should be almost higher than inflation, but unfortunately the interest rates and inflation piece here go hand in hand as market drivers. So the last piece is going to be regulation. And this is a huge open-ended ball game. You know, one thing that I think needs regulation in 2023 from an equity market perspective, we could talk about crypto in a second, but if you look at the financial markets, there's one specific market segment to me that is absolutely screwed up. It benefits only one group of people, and that's the people that create them. And to me, it's been a colossal failure of the financial markets, and it's got very, very little regulation. I'm curious, what do you guys think it is? Tell me what you think it is. There's one area in this market that I think needs absolute regulation, much steeper requirements, and I guess, not requirements might not be the right word, but oversight of this specific market segment, because I think it's just brought in a lot of pain. I think it's been a resounding failure for the financial markets. So what do you guys think it is? I'll give you a couple seconds. Actually, I'll type in a ticker symbol over here so you guys can maybe see a representation. Ticker symbol, how about DSPC? Crypto is definitely going to get regulation. But I don't, when I said that this is a small market segment, crypto, I wouldn't argue, is not a small market segment anymore. It is a huge market segment. Oh, Tom, that's a good one. Taylor Swift tickets. Yeah. Do you mean Ticket Bastard? Get rid of Ticket Bastard. I hate Ticketmaster, as you guys may all know. So the segment that I think needs to be regulated, number one, in our markets, I think our markets are functioning fairly efficiently. But we talked about SPACs, a specialty purpose acquisition company, I think in 2020. And I call them, are they a necessary evil or, the greatest thing ever? And I have a lot of skepticism around them. And I come to find out that really all they are is a money grab. And whoever is underwriting those SPACs gets the lion's share of the profits. And almost all of them have failed. They've been miserable performance. So, you guys might remember when I was talking about SPACs, I was saying that, for those who don't know, a SPAC is a stock that's created, and all it does is designed to buy a private company and bring them public, right? So they have 2 years to do that. So they raise a bunch of money, and then they go out there and they find a company that's private and bring them public. So let me put your hat on. You guys all work for the Merlin SPAC, right? You all work for the Merlin SPAC. We're all one big company. We're having a conference call right now for the Merlin SPAC. I'm like, hey guys, we just raised $150 million. We have 2 years to find something. If we don't find a company to bring public in 2 years, we have to give all that money back. Plus, it's going to cost us probably $9 million just in fees to get all that money back. So obviously, we're going to buy something. Now, we could do the due diligence, go out there and find the most amazing, awesome zombie company, a real company, or at least a zombie company out there. Now, the problem is, and I mentioned this when I did my show in 2020, was Merlin SPAC could go out there and go to any company. They could sell sculptures of dog poop, right? Well, poop.com. And we're like, hey, okay, I'll tell you what. We've looked at your balance sheets. Your company's only worth $1 million with all the poop you sell, but we're going to give you $100 million. You'll buy your company for $100 million. As the SPAC, I get to keep 20% of the SPAC shares. Did you know that? That's the average, is they keep 20%. So all I have to do is buy something. No one can see the financials of the company I'm buying except for us. We bring it public, but we pump it the whole time so that it let's say it should open up at $1. Well, we're pumping it. We're going to make the thing open at 30, 40, 50 bucks, and then they all come falling apart. For the most part, it's a scam. And I made the point that these guys are going to overpay for the companies they're buying because they don't care. They get to sell right away as soon as that SPAC happens. So let's just look at a couple of those SPACs that have happened in the recent times. Lucid is probably one of the biggest ones, right? And it's actually a legit company, but look at the SPAC, right? It was $10 when they first started back here in 2020, spiked all the way up to $65, now $6.17. And you can make the argument, oh, it's because the markets are in bad spot right now. No, it's because they overpaid for this company. WeWork is another great example, right? WeWork, here's your SPAC price of $10. It actually spiked up to $14.80. Now trading at $1.40. Womp womp. Space. Right, here's the space ETF or space SPAC, which was at $1, and then rallied all up to about $65, $62. Now $3.49. So it seems like they all. Are you suggesting SPAC should have skin in the game for the company they bring to market? They do have skin in the game, because if they're buying, let's say Merlin SPAC decides to go buy poop.com, I'm getting 20% of those shares. Our SPAC is, right? So now my only goal is inflate that thing as much as possible. Pump it, and get it as high as possible. So as soon as that SPAC happens, we can sell all of our shares of it as Merlin SPAC and walk away and do it all over again. It's a flip thing. It's BRCC. Is that another one? Another one, BRCC. And you can tell the charts of SPAC, if you're ever wondering, they all start off at $10, and they have these wild fluctuations, and then boom, boom. It's funny because I was in one. Luckily, I made money off it, but I can't even remember the ticker symbol for the one that I was in. But there's so many of them. There's even DSPC, which is a fund that it's an ETF for SPACs, and you can see it's basically had 2 months of glory, reached a high price of $34, and now is trading at $5.11. So I think that this is a joke. Yeah, DWAC, right? Wasn't that is True Social DWAC? This is the Donald Trump one. This one's actually still up just because it's got Donald Trump's name all over it. So, I mean, look, he has an impact and he's going to move these markets. But ultimately, this will probably do the same thing. It'll probably just keep on drifting lower. Ultimately, this thing will be under $10. My guess is Trump probably had a pretty big hand in the DWAC and got a whole bunch of shares there. So I think that this industry is given a black eye to the financial markets. There are very, very few SPACs that have made it. So I think regulation from one perspective would be things like this, right? Let's fix that problem. Number two is a much bigger can of worms, which would be the cryptocurrency regulation. And what you're going to see in 2023 is absolutely crypto regulation. You're going to see regulation on stablecoins, you see regulation on exchanges, and broader regulation on the crypto markets. I actually think that's a very bullish thing. Part of the discussion I'm going to have with my CIL students tonight deals with the Bank of International Settlements' recent report on crypto. And that is probably one of the biggest events to happen in the last 5-6 years of crypto. If this whole initiative by the Bank of International, remember this Bank of International Settlements is the bank for central banks. It's the central bank of central banks. And if they're creating rules that in any way, shape, or form promote adoption of cryptocurrency and digital assets on a central bank level, you can expect a big rally. And I am expecting a pretty big rally, not in 2023. I actually think that crypto is going to be pretty flat and boring for 2023. Slightly up would be my forecast. Merlin, SPAC based on poop NFTs would be awesome. We can pump it as AI, VR, EV. Yeah. I mean, there's stranger things that have happened out there, man. There's so many garbage companies that have come up, and this is where you have to do your due diligence. But SPACs are really just, I feel like for the most part, they're a scam. I feel like they're a fraudulent thing where the people who are bringing the private company public can overpay so much money. And by the way, the loopholes for SPACs, these private companies don't have to abide by any of the traditional documentation, spreadsheets, all that stuff that an IPO would have to. Right? There's all sorts of hoops they have to jump through, but not with the SPAC. SPAC, you get right around all that stuff. So I think that's the next biggest piece. And then, other regulation will be really the crypto space, and I could do a whole show on that one, but I do that for my CIL and anybody who is part of the XLT General Sessions. I'll probably talk about some of the regulation going on here for crypto. So those are my biggest four. Interest rates, number one. Number two is inflation. Number three be bond markets. And then regulation as it pertains to the market. So I guess overall, it brings me back to this chart here. And it says, let's go to SPX, or Cash Index. Basically says, well, where are we going to be? Well, my forecast is this. At the beginning of the year, I thought we would sell off 20% or more and then rally back up and be down about 15. Well, I was wrong. We were down 18 and we went down more than 20%. I think you're going to get a lot of chop here as we still try to navigate this uncertain ocean of economic data. We still don't know what the Fed's going to do with regards to interest rates, but it does feel like a bulk of the main pain of that I word of inflation has been subdued a little bit. So my guess for the year is you will probably see something that looks like this. Let me turn on to automatic pen. I think you might see a market that does something like this. I think it's going to be a lot of chop, but I don't think you're going to see a lot of end result. I think you're actually going to see a market that's pretty unchanged. So I'm going to say my target for next year, by the end of this year, will be slightly up. I'm saying 3,900. And I think you're going to have some pretty big swings up and down. I think we'll go above 3,900. I think we'll go below the lows we saw this year. Maybe not. Well, hold on, not this year. I think we're just going to chop. Man, this might be more dramatic because I hadn't zoomed in. But I think we're going to just have a lot of choppiness here. I don't think you're going to get any real clear trend, which is going to make it a challenging year for anybody who's a swing trader, right? If you look at most of the big traders from like the CME. So if you talk to someone like Bob Dunn, he's about ride the wave. We may not get much waves. We may get a fairly flat ocean, little ripples here and there, but I don't think you're going to get those really big moves this year. Maybe after the presidential election coming up next year. But I just don't feel like you're going to have a huge volatility. I could be totally wrong, and if I am, awesome. I'll be happy. Yeah, that was on a daily, Kevin. I should have zoomed out a little bit and done it on a weekly. But I do think you'll see these swings happen. But do we get? Oops. Question I guess I have is, do we get down below these lows? Do we break the lows for this year? I don't know. I don't really think we do. Why just stop drawing my magnet? I'm trying to edit these lines and it's just not working for me. So anyway, I'll leave it. So 3,900 is mine. I think we will. Yeah, good for options, absolutely. And I'm really I'm expecting to have a better year with my options in all my options accounts. I have one new account. I'm going to be implementing some different strategies for this year. But if we get a choppy market, that means I'm more inclined to sell at strikes that are closer to at the money, and that will get me a lot more yield. If markets just chop sideways, it'll probably be a phenomenal year for me because that's what I'm building up as my plan. It's a long. I think it's for the year. If you want to go the whole year, so I guess that's what you're focusing on here. I'm not going to leave these lines on this chart by any means because that would be just torturous for all of us. But there we go. So now I guess I can start here and draw it the right way. Because the end of the year, if you look at where we're sitting, you're looking at, there's 2024. So if I'm looking all the way to the end of the year, I think you're going to see a lot of, let's just do this. We'll go there. They could pop up. They could pop down. Pop up. I think we probably will just break these lows a little bit. The lows we established in 2022. And just to get more head fake in there. And then I think you'll start to see it drift back up. So this is by no means an accurate representation, but I'm going to go 39, and there's my level right there. So there you go. That's better, Kevin? That's why I think you'll see something like that. I really don't think big trends. I'm happy my ETF portfolio ended at 11 plus, so that's a win for me. Yeah, awesome, Kevin. That's great. Hey, and I mentioned this with the viewers, like, we ended up down 18% on the S&P, and if you had a negative 15%, you actually beat the market. It's horrible to say that, but your goal should be to get option spreads. Yeah, I know. It's funny. Larry's been bugging me on that. I'll probably start sitting in Larry's options class, his trading weekly options, because I think that's probably where I more want to go. One of my New Year's resolutions is I want to get back into shorter term, much more shorter term. So a lot of the stuff I've been doing for the past couple of years has been predominantly swing trading, because I've just been working so much on other content that I really want to. I'd rather get back to day trading and doing shorter term stuff. So if I can, get weekly options down and get a better rate of return, then I'll probably do that. So I'll be looking at Larry, do a little Larry weekly stuff. I know you took Larry's class, probably learned some stuff on the weekly options there. You also did the Tim Blotzer thing, right, Tom? I think you've done it with a few different people before you finally refined your strategy. Okay. Wow. I didn't realize it was such a late we were so late. I'm going to wrap things up right here. So that's my forecast. Last year, I think I did gold and silver as well. Look, gold, by the way, looking great. I don't know if you saw the break recently on gold. Let's go back to our daily chart here. You had this break out of this consolidation, and we talked about it. It felt like it was pressuring higher. It broke through, and if gold gets above this, 1875 mark, I mean, you can find yourself back at, getting close to $2,000 on gold this year. I think 2,000 is my target for gold this year. So I will be looking at selling some puts on gold at the money And if I get exercised, I'll just sell some calls against that. But that will be part of my play this year. Will be what I feel is a general bullish move on gold overall. And I like the chart. You know, we have this nice bottom out here at 1625. Now starting to make some new highs. Nice big uptrend. So I think gold is there. Silver will also be a play since that was my best performer last year in my portfolios overall. I actually targeted 2350. We hit that by March. And then, of course, finished much lower. So I'll probably trade in some silver as well, but I like what's happening out there with gold. Here's your economic calendar for tomorrow. Now, finally, we get some good news, some good announcements for the U.S. You can see here, 30 minutes into the trading session, you have ISM manufacturing PMI, JOLTS job openings, and manufacturing prices. You also have FOMC meeting minutes. Holy cow, Kevin. Well, Merry Christmas. Thank you very much for that one. I'm going to start blushing over here, but thank you, man. I really appreciate that. That is a wonderful contribution. I appreciate that very much. And thanks for the support over the years on the show. Wow. All right. And that's pretty much it. You don't see too much else for the rest of the world. You know, you have a 10-year bond auction, but, you know, whatever. Who cares what's happening to the 10-year bond auction in Japan? We know they just lifted that ceiling a little bit, but nothing really concerning there. For the UK, you don't have too much. You have some mortgage approvals, but I don't see anything here that's really ground shaking with regards to announcement. All right. Cool. So that will do it for today. Chris, that's your target, 3250. Okay, I'm going to make a spreadsheet tonight that has everybody in there, right? So I'm going to make a spreadsheet, put all those names in there, plus your January competition, your January challenge pieces that you decide to enter, and that I'll add to that table as well. Tomorrow, what's tomorrow? Tomorrow's Wednesday. I'm going to have Todd Davis on the program. If there's something specifically you'd like Todd and I to talk about, let us know. We would love to talk about anything. Todd and I, you know, we're pretty much open slates with regards to markets. So if you have something specific you want me to talk about with Todd on tomorrow's show, you can email me at TraderMerlin@gmail.com or put it down below the YouTube videos. Any video out there, just put it down below that YouTube video, and that will do it. August, I got to run. I'm going to push this to an hour show. So what caused the dollar to go so high today? Okay, fine. I'm not going to run. I'll do the Dixie. Just a real quick view. You know, you have a lot of factors out there. I think that oops, my TradingView drives me nuts sometimes. But as far as you know, what happened? Let's go to an hourly. You know, you had that big surge. It's just the beginning of the year trading. Remember, markets have been closed for a little bit. If you look at what happened to the equity indexes, well, it's just pretty much the opposite of the equity indexes. So markets were selling off, dollar was rallying. That's, you know, hand-in-hand action there. What was causing specifically the dollar to go up like that? Not really sure. We can always point the finger at some of it. At this point, I don't know. Okay. Cool. Well, that's going to wrap it up. Let's see, Tom, what do you say? See more rubber document. Also apart from Corey. Yep. Yeah. And that's the thing about having people around you that, you know, that you learn from. The more people you can have around you. I think that the challenging part that you have, Tom, is finding out who is legit and who is kind of talking out their ass with regards to trading and investing. You know, you want to get yourself a Sam out there who just can talk one thing. Supply and demand. Okay, I'm going to talk supply and demand. I don't know anything else about the markets. He sounds like Kermit the Frog when he talks, but it's like, dude, you only know two words, supply and demand. You know absolutely nothing else about financial markets. You're amazing. Anyway, that's going to do it for me for today. I'll have Todd Davis on the program tomorrow. If you want us to discuss anything in particular, let us know. TraderMerlin@gmail.com or put it down below the YouTube video. That said, happy Tuesday and happy January. I hope we get a great remainder of this month. I'm looking forward to some fun trading this year. Take care, everybody. I'll see you tomorrow.